Hello and welcome to our first video on Module 11. This is Video 1, Financial Reporting. I'm Jeff Mankin. I help you learn accounting and finance. All right, let's just talk about corporations. Here are some advantages. Advantages would be things like it's a separate legal entity. That means it's separate from the owner. It has its own legal status. It has limited liability. Now this is important because you can only lose the amount of your investment. You can't lose your personal assets. The next one that's an advantage is the transferability of the ownership. It's easy. You sell or buy and you become a stockholder. If you buy and you sell, you no longer are an owner. So that's easy to transfer ownership, much more so than proprietorship or partnership or whatever. It has continuous life. It can last longer than the owners. And it's easy to accumulate more capital in a corporate structure than any other legal structure for a business. Now, let me reiterate, the biggest advantage is, look how happy this guy is the limited liability. The losses are limited to the amount invested, and so it protects your personal assets. This is a great advantage of a corporate form of business. The big disadvantage on a corporation is the idea of double taxation. Now, a corporation does not pay tax on everything. The corporation pays tax on its corporate profits, so there's a corporate tax. And then when they pay out dividends, then people are taxed, or individuals or companies are taxed on dividends. So double taxation is related to the tax on dividends. So some people say dividends are subject to double taxation. The other thing that happens is, for a corporate form, you have more regulations, more tax. So that's the big disadvantage of a corporation. Now let's talk about corporate structure here. At the very top, you have the stockholders, the owners of the business. Every stockholder has a chance to vote and make their voice heard. One share equals one vote. So all the stockholders combined, there may be 8 million shares that represent the ownership, or 50 million or whatever. All that is the ownership. That's stockholders. Certainly one stockholder can own more than one share. If someone owns 51% of the shares, then they have 51% of the vote, and they basically can control what the company does. The main role of the stockholders is to elect a board of directors. The board of directors then sets policy. They hire the CEO, the chief executive officer, all the other C-suite type individuals, chief information officer, chief financial officer, and so on. That would be in management, and then you have employees in the bottom of that corporate structure. Now, the rights of the stockholder, they have 5 distinct rights. If you own a share of stock, you have these rights. You get a right to vote on the board of directors and for big policies of the company. You have the right to sell anytime you want to. You have the preemptive right, and the preemptive right says, look, if you own 10% of the shares of the company and they issue some more shares, then you have the right to buy 10% of any new shares. You have the right of first refusal, so you can maintain your 10% ownership interest. You have the right to receive dividends, either cash dividends or stock dividends. Every share receives the same amount per share. And then you have the right at the very end the right for any remaining assets that if the business has to liquidate, you have the right to receive any remaining assets that are left over. Typically, this is not going to be a right that you want to use, and typically if the business has to close, there's not going to be very many assets left. All right, so here's a share of stock. This is Disney. Share of stock, so we're going to point out a couple of things here. It's a common stock, so it represents the normal ownership of the business. It has par value in the upper right. Par value is 1 penny. It's common stock and has all sorts of things. This share is 1 share and apparently has not been issued, so it's a sample share. So let's think about the different levels of ownership. We have three terms we need to keep up with. The first is authorized. Authorized is the number of shares that the company could issue under their current corporate charter. The corporate charter is a legal document that you file with the state. It's basically an application. And so for this company, for example, they have shares authorized of 10 million shares. They could sell as much as 10 million shares under the current corporate charter. Now, a smaller set of that number would be shares issued. These are shares that have been sold at one point. The first was 10 million authorized. Now we have issued 8 million. Sometimes a company will issue shares and then repurchase them, or a stockholder would sell the stock back to the company, and so therefore we'd have a smaller number that would be shares outstanding. So in this case, 10 million shares authorized, 8 million issued that have been sold before, and outstanding 7 million. Now the 7 million represents the ownership interest. They're the ones that get to vote. They're the ones that get to receive dividends. So this is the important number, is the shares that are outstanding. So let's think about this again, just to reiterate here. Authorized is the big number, how much they could sell. Issued are ones that have been sold, and then outstanding are the ones that are still owned by the stockholders. The difference between issued and outstanding is they have been sold at some point, but for some reason the company has repurchased those shares. The difference between issued and authorized, the 10 million and the 8 million the 2 million have never been sold. All right, let's think about different terms here that we want to know. One is the stock price. Stock price is really the important number that matters. Sometimes we call it the market price. So if you own 1 share or 10 shares, 100 shares, you care about the stock price of your company. So if the stock price was 40 and you own 10 shares, your stock investment's worth 400, and the price could go up, the price could go down, and it trades, on a regular basis every day on a business day. Now, this is common stock. This represents the normal ownership interest. There's such a thing as preferred stock, and that is really more of a dividend kind of security. Doesn't really represent ownership the way that common stock does. Now, I point you to this. We talked about this a little bit earlier. Par value is typically a real small amount, like $1 or 1 penny or whatever. This is a legal term, and so if you look at this share of stock is surely worth more than 1 penny, and that is a legal term that must be, when you make a journal entry, you must use par value if you have it. Now, it could be no par and have a stated value. If you have a stated value, use that so it functions just like par. Technically, it's not par, but a stated value will be the same thing. If you start a new corporation, you probably have the ability to say, hey, we're not going to require a par value. So these are legal terms. They don't really have economic significance, but they are a legal term that you need to know. Now remember, this whole area is stockholders' equity, and the two categories of stockholders' equity are paid in capital. Paid in capital is when you issue stock, like this certificate, and you receive cash. So paid in capital is the first category of stockholders' equity. The second category is retained earnings. You have a net income, and retained earnings would grow. Any dividends would make it go down. So let's think of it this way. Stockholders' equity, remember, the two categories, paid in capital and retained earnings. That's a part of the accounting equation. Assets have to equal liabilities plus equity, and it's on the balance sheet. All right, thanks for watching this video. See you in the next one.